All right, good morning. Today is September 18th, 2024, and of course, as you know, it's Fed announcement day, and the Fed is expected to embark on a rate cut cycle, and it's been a long time. Um, so today is going to be a pretty amazing day because everybody's been waiting for the proverbial Fed pivot. That's all they've been talking about on CNBC. I would assume because I keep the sound down, but um, I look over occasionally, and of course, everybody has an opinion on whether the Fed's gonna cut 25 basis points or 50 basis points and the implications of that. And I've actually got some interesting charts that I've gathered from around the web about the implications of that. So I did quite a bit of reading on it. And some other cool stuff. So I like to keep these shows at 30 minutes because 30 minutes is these days that's pretty significant attention span to begin with. But I typically gravitate like everybody else, I'm sure, towards faster videos that are not very long. So I think keeping the show at 30 minutes is the right way to do it. So anyway, let's dive right in here. Before we look at the charts of the market, let's look at, let me close this. Let's look at a few of these charts that I saved from around the web. And of course, they're going to display a little weird. This is a humongous chart. And these are in no particular order. I've got some interesting charts about the implications of a Fed rate cut, whether they go 25 or 50. I did see a comment today that said that no one is talking about the fact that maybe the Fed won't make a move, right? Imagine that. So I've seen that the odds of a 50 basis point rate cut are running between 66 and 69%. So, and that's funny because I mean, think back to last year and the year before the Fed pivot, and think back to the beginning of this year when the predictions were for like 6 rate cuts and all this kind of stuff. So it's really, there's a lot riding on what they actually do here. And so, but real quick before we get into that, I just thought this was extremely interesting. This is the Buffett indicator, right? The infamous Warren Buffett indicator that measures the total market cap. So this is the Wilshire 5000 market cap compared to the GDP. And as you can see, this is what's most interesting about it. Back here, there's 2000, the dot-com bubble peak. And so I know it's hard to see, but I can zoom into this. So 150%. This was probably, it looks like about 140%, the total market cap of the US stock market compared to GDP, which, Warren Buffett is obviously, he's been lightening up, right? He's been sold a bunch of his Apple and his Bank of America, and he's sitting on more cash than, most nations have. And so it's kind of interesting just to see where we are here, right? And so this would have been the all-time high in the Buffett indicator prior to well, there's COVID right there. And so prior to like this last dip, I guess that's kind of interesting. A couple of years there that it went from 200 to 150. But anyway, the gist of it is this is the Wilshire 5000 compared to the GDP, the old Buffett indicator, and it's got this big double top at about 200% here, which, based on the fact that this chart goes back to 1960, what is that? Well, no, I'm sorry, 1986. So you can see that valuations are elevated, as they say. So this is Zero Hedge's rate cut cheat sheet, which I thought was pretty interesting. It's actually a little bit more interesting than the rest of the charts that I have because it gives you more information. So basically, the whole gist of the rate cut debate is this. The last two times that they embarked on a rate cutting cycle, which they're about to embark on today, if they cut 50 basis points, and I mean this goes back further than the other charts, but since like 1995, if they cut by 50 basis points, then basically, that happened in '01 and '07, and then you get a recession. Historically, there's been a recession and the market is lower, right? So the people that are hoping they cut 50 basis points might want to rethink that, because that has the potential to spook the market. And so it's going to be, it's going to be extremely interesting. I saw someone comment, this is like the Super Bowl for financial people today. So, especially because, the odds of 50 basis point rate cut are so high when they weren't, just a couple of months ago. And then they were prior to that, So anyway, but here's this is just an interesting little chart that shows you what the 3-month, 6-month, and 12-month return on the S&P is after the Fed started cutting rates. A rate hike, or I'm sorry, a rate reduction cycle. I keep thinking rate hikes. And so here's one that only goes back to the 19, it's got the last 5. This is a very interesting chart too, because just like I said, if the first cut is 50 basis points, the last 2 times that's happened has been, right after the dot-com bubble in 2001, and then of course the great financial crisis in 2008. And there's the return of the market. It's been lower. And then these other times, they only cut 25 basis points, and then 12 months later, the market was higher. Interesting. This is an interesting chart too. This is the 2001. Right, there you go. Well, I guess it was January of 2001. So this is the dot-com Fed funds rate cutting cycle. And then this is the great financial rate cutting cycle. And so basically what this is showing you is both of these times the Fed started with 50 basis points, and we both know what happened to the market subsequently. So that's kind of interesting. And it's interesting to see the Fed funds rate superimposed on a chart of the market, which is very cool. So anyway, here we go. And the gist of it. Oh, this is these charts were in no particular order, so I don't want to go on and on and on about 25 or 50 basis point rate cut and all that. And so my personal opinion is that if they go 50 basis points, then that may spook the market just based on what we looked at, right? Because that will signal that the Fed's kind of, anticipating a recession perhaps. The market's already done a lot of cutting for the Fed. Mortgage rates are down fairly significantly. They peaked at 8 something and now they're 6 something. But this was the other most interesting chart that I stumbled across recently, today, is the S&P. Somebody posted, when's the last time that the Fed cut rates with the market right near an all-time high? And then there was a bunch of responses to that. And, first of all, you have to define within what percent of an all-time high. And so, everything is debatable and subjective these days, because some posts ignored, the market unless it was, I think it was Ryan Dietrich posted a chart, and it didn't even have the Fed rate cuts on there in 2001 and 2007 because the market was not within 2% of an all-time high. So anyway, it's just funny, but I stumbled across this chart, which is somebody posted priced in gold. The S&P is nowhere near an all-time high. And so I thought that was pretty interesting too, because we all know that gold is trading for $2,600, which is the all-time high in the history of the world, priced in U.S. dollars, I should say. I mean, gold's been hitting highs in every currency, and so we all know that story. right? But this is just a really interesting chart because, if you recall back here around, around 2000, gold was like $400 an ounce or something, 300 and something. I think it was down to like 360, $400. And so this is basically just the gold S&P ratio, which makes more sense than the gold Dow ratio. So I am not a big fan of the Dow, and quite frankly, I'm amazed that it's able to track so well along with the S&P. But yeah, so this kind of, I didn't have these charts in any order, but this would kind of go along with like the Buffett ratio. So I'm not sure what this is telling you. I mean, this is telling you that the price of gold has gone up significantly. And quite frankly, I mean, they don't talk about it a whole lot. Of course, like I said, I don't really listen to CNBC. I'm sure they've mentioned it, but um, gold is outperforming the S&P so far this year. As amazing as that is to believe. Um, so here we go. Look at this. I mean, you talk about a double top. This is about as double toppy as it gets, right? Another interesting thing, I looked at a lot of charts from the prior rate cut cycles, and what something that sort of stands out that most people that follow this stuff closely are aware of is the idea that sometimes and recently, a couple of times, 2000 and the 2001 and the 2007 rate cut cycles, what happened was the market was up near the all-time highs, and then they started cutting rates, and then it popped up and made a new high, and then rolled over and tanked, right? So that's sort of a possibility too. It gets you thinking, and I guess a lot is just going to depend on whether we are indeed headed into a recession or not. That's going to be the important thing, right? And that's debatable too, whether, how much the economy is slowing down, whether we're going to get a recession, um, whether the Fed should even be cutting rates. And so we haven't even talked about the idea of, the inflation thing, right? I mean, they didn't for a long time there. They basically were saying that they were not going to cut rates until the inflation, until CPI was at 2% for, a sustainable period of time. And so now they're balking on that. And I got to tell you, it's just that's what I think is the most troubling thing. And you're not hearing a lot about that, but the problem is if they start to cut rates here and then inflation comes creeping back, well, then we're all really in trouble because we know that inflation compounds. And I talk about this inflation a lot on this show just because it's like one of the number one things that affects just about everybody, and it's the fact that everything has gotten so expensive is one of the main challenges in America these days, that the price levels, and inflation compounds, right? It's like compounding is the eighth wonder of the world, and boy, when you start compounding inflation, you're in real trouble. So anyway, here's the S&P, big double top, and by the way, all this macro stuff is fun to talk about, and it's interesting, and it's one of the big things. But interestingly enough, I read an article this week that essentially the gist of it was that macro has absolutely nothing to do with how you should be positioned in the market and what your returns are going to be and all that. And basically you know, it had to do with just basically using momentum, being in the right stocks, the right sectors, market timing, avoiding big drawdowns, that type of thing. And so, I mean, and I quite frankly, I know a couple of professionals that I guess they figured that out a long time ago. Um, One likes to say that he doesn't even watch the news. So my curiosity, when the market makes a huge move, or something happens or whatever, my curiosity gets the best of me, and so I want to know why it moved. But there's a lot of smart technicians that go just purely by the charts, and quite frankly, I mean that's pretty much the way to do it. So, whatever your long-term global macro outlook is for, the global economy, that has nothing to do with what the stock market's going to do today. So, the most interesting thing about today is going to be to see what the reaction is over the Fed announcement and see how it's parsed out, and then see what Powell says in his press conference. And so, yeah, it's going to be a very interesting afternoon. Today's open was nuts too. Today's the kind of day where most traders are probably best off just sitting aside and enjoying the show, right? You don't try and trade these days because there's a lot of shenanigans that go on, and just a lot of erratic price behavior, and the algos are going to try and stop out the longs and the shorts multiple times today, would be my guess. And plus the ATRs. Like I'm looking at the ATRs on the ES. I mean, yeah, the opening 5 minutes was 12.75, and you're looking at 5 to, yeah, 5 to 9 S&P points per 5 minute price bar, and so it's kind of dicey trading. It's very dicey trading, and then of course as soon as the announcement comes out, look out. So here's the S&P. Big double top here. Keep in mind that if it does break out here, that doesn't necessarily mean that, it's blue sky from here to the end of the year, because, as I mentioned, and part of why I showed those slides was that, if the economy is indeed headed for a recession, which is debatable, then, it's entirely possible that the Fed starts cutting rates, market makes a new all-time high, a nominal new all-time high, and then rolls over, and things get ugly. So let's look at the Qs, just because we know that the Qs are not near an all-time high. So that's kind of interesting. And we've had this little rally here, and it's kind of stalled out. So it's going to be interesting to see what happens with this too, right? Obviously, this run that we had from April to July was a humongous move, and that was the big AI tech rally, chip rally, all that kind of stuff. And then, the NASDAQ 100 had a pretty significant sell-off here, all the way down to the 200-day moving average, and then we got the bounce and another, higher low. So this is, last week I drew a big triangle around this, but what you have here is, we're kind of at sort of an inflection point, because you've got, in the near term, you've got a higher low and you've got a lower high. And so this is a big triangle, and it's going to be interesting to see which way it busts out of it. IWM, the small caps, extremely volatile. They look a little bit more constructive, but obviously, let me flip over to a weekly chart here. This is an interesting pattern, because this could potentially be forming like, it's a big giant cup. Your cup patterns are extremely powerful. Like, you guys remember when I was I was pointing out this cup, and oh jeez, I hate when that happens. Oh boy, look what happened. That's what happens when you make a typo. You guys have been watching this show for a long time. Well, remember that been watching the show for a couple of years. You'll recall that I characterized this, back when we were in this pattern here over the past couple of years, as a big giant cup and handle, which looked like it was going to break out. And at the time that I was talking about that, I mean, things were looking pretty dicey, like back over here and over here especially, right? This pullback we had last year. I mean, things were looking pretty darn dicey. And I was like, well, if you totally ignored everything, I remember saying that if this was a stock and you didn't follow any news or any macro or any of that stuff and just looked at the chart objectively, it was a big giant cup and handle on the weekly chart. And of course I drew the little bull flag right here, and sure enough. So, yeah, I learned a long time ago that that I mean, it's hard to ignore the macro because that's all they have to talk about, really. I mean, that's a lot of what is discussed as far as what's going to lead the stock market is macro driven, the Fed and all this and that, but then, there's a lot of people who've been doing this a long time will tell you that what's more important is liquidity, right? And there's a lot of other things that affect the market, one of which is liquidity. And that's the main driver. And so whatever you think should be causing the market to go down doesn't necessarily do that. It's not necessarily relevant, although people like to pretend that it's relevant. And the other thing is that it's the stock market's job to keep up with inflation, to basically, preserve purchasing power to some degree. And so, of course, that varies a lot, and which brings me back to that chart of stocks priced in gold, which is pretty interesting. So, that's kind of between gold and the stock market. Those are the two things that are investable. And of course, now the I'm old school, but younger people will tell you that that's what Bitcoin's for, right? So anyway, here's the cues. Interesting sort of little pattern here. And looking at the weekly chart, last week, I don't think anybody expected I don't think anybody really expected last week to be, this particular pattern here. And that's actually kind of a bullish pattern. You get a big sell down like that, and then all of a sudden you retrace the whole thing and close higher, right? So, I mean, actually, the last since July, right? And look at that pivot high. Like that's basically a textbook pivot high right there in the Nasdaq 100, the first week of July. Let's look at. I meant to put in SPY last time. Yeah, so looking at the weekly chart here, this you call it a double top or whatever, but when you look at the weekly chart, man, it's a line in the sand, right? So this is like a brick wall. This is overhead resistance, humongous amount of overhead resistance. And there's a couple of ways to think about this. One is that if it breaks out of this, then it could just rip higher, right? And so the psychology is that this is where all the sellers is up here, right? Let's look at the actual SPX for a second, and because it should look very similar. Yeah, I wanted to look at this because I actually have my overhead resistance drawn on here. So you can see that in the past, this week, all these weeks when the S&P got up to these levels here, right about where we are, a little tiny bit higher, but I mean, this is a zone, right? This is an overhead resistance zone, and it happens to be the nominal all-time high in the history of the world for the S&P. But every time it gets up near these levels, previously everyone's been a sell. There's been more sellers than buyers, I should say. I almost said everyone's been a seller, but basically you're getting more sellers than buyers up at these levels. And imagine how many stop losses are just above these levels, right? So there's every possibility of a fake out breakout, right? And that's going to be kind of interesting too. Fake out breakout would mean that there's all these stops up here, and probably layered in above the highs. And so if they can break this market out, and there's a reason to too. See, sometimes the market, um, it would seem awful obvious, to break this thing out on no news and take out all the stops and rip higher, but today would be the perfect opportunity for them to test the stops up there and take those out if the market has a positive reaction. And so the question to me is not whether they're going to lower by 25 or 50 basis points. The question is how will the market react? Because there's quite a few economists that are calling for bigger rate cuts because they feel as though the writing is on the wall, that the economy's slowing down. You're starting to see layoffs with these big companies, and the writing's on the wall that we could potentially be headed for a slowdown, a hard landing, as they like to say now, and or worst case scenario, recession, in which case the Fed is going to be blamed for hiking the rates all the way up to 5.25%. They're going to take the blame for that, and so that's another reason why they may decide to go 50 basis points. And then, of course, we haven't even talked about the interest on the debt and all that good stuff, but it's going to be extremely, extremely interesting and exciting to see, what the market reaction is. And that's the most important thing. It's not important whether they cut 25 or 50. That's, not going to make a big difference in the big scheme of things. It's going to be the narrative surrounding it and how the market reacts, and you're going to have, people are going to say they made a mistake no matter what they do. That's going to be the funny thing, because, and of course, we're right before an election too. I mean, I saw somebody post something to the effect of the Fed should do absolutely nothing this close to the election and see what happens, right? And of course, the Fed, Jay Powell will say he's not political. So that'd probably be the most interesting thing is, when he does his press conferences, no one ever asks him the real questions, but the real question should be, and hopefully, they get into a discussion about inflation, is, we have not seen the CPI come down and hold at 2% for a period of time. In fact, I believe core inflation is, considerably above their target. And so why are they going to go on this big massive rate cut cycle when inflation has not been conquered? And that's the thing that should worry everybody, because boy, if he makes a mistake, if they make a mistake, if they start, cutting rates or whatever, and inflation kicks back up, then there's a big problem. And so that should be the number one worry. Anyway, that's it. I could talk endlessly, just like everybody else does, about the implications of the Fed rate cut today, but best to just sit back and see how it plays out. And then this time next week, when I do the show again, we'll know how it played out, and we'll have some trading days under our belt to actually analyze and see what things look like at that point. So, hey, thanks for tuning in. I'll see you back here, same time, same place, next Wednesday.